Meanwhile, Fed officials are spread on the outlook for rate hikes this year, but the goal is clear: return inflation to a target of 2%. Inflation saw a meteoric rise in 2021 and 2022 and has stayed stubbornly elevated. Mickey Levy, Berenberg Capital Markets chief economist for Americas and Asia, blames the Fed's initial, what he calls erroneous inflation projections, and calling their policy response misguided. Those factors have contributed to what he calls the, quote, biggest monetary policy error since the 70s. Mickey Levy joins us now. So first of all, thank you for joining us. And second, why do you say it's their biggest error since the 70s?
Well, clearly, when inflation accelerated dramatically and the Fed basically said it was transitory due to supply shocks, grossly understated the significant impact of the biggest deficit spending and monetary ease, since the 1970s. And so now the bind the Fed is in, it's paying the price for its dithering in 2021. But let me put a positive spin on things. The Fed has raised rates aggressively, and it now has the federal funds rate modestly above inflation, which is good, and it should start slowing the economy somewhat. So the Fed is in much better shape. We should expect inflation to drift down. The critical issue is inflation, as you note, has been sticky, and it's going to come down, but it's not going to come down to the Fed's 2% target. And then the question is, what does the Fed do as inflation recedes modestly but stays stubbornly high?
So, Mickey, if they made that mistake and now they've sort of mostly caught up to it, what's the biggest risk now? And I'm curious if the risks are more weighted to them going too far or not far enough.
That's a great question. I think the risks are fairly evenly balanced. The economy, as you've noted, has been quite resilient, not just in housing, but consumer spending. And let's emphasize that so far, at least, businesses have responded to slower product demand, not by massive layoffs, but by just slowing rehiring. So things are in very, very good shape on the real side of the economy. Certainly, it's a risk if they hike aggressively further. However, on the other hand, if inflation remains sticky high, then that sets a new base. And should the economy strengthen from here, like not right away, but over the next year, you could get an accelerating inflation from a higher base. And that is a definite risk to the Fed. So these risks now are two-sided, and it's a very thorny issue, and the Fed's put itself in this bind.
And Mickey, so you said if they hike aggressively further, what would you characterize as aggressively further? Is that 50 basis points, or is that more than that?
Oh, so that's also a great question. 25, 50 basis points isn't going to matter that much. I'll toss out another risk. What really affects the economy, and with a lag, is not the nominal rate, but real rates. So that if the Fed hikes one or two times more, but keeps rates high as inflation comes down, then the Fed becomes inadvertently tight by real rates, that is inflation-adjusted rates, rising and squeezing on credit and aggregate demand.
Well, that suggests that even if they stopped right now, they would keep tightening for that reason, right?
That's right. Once again, the Fed, all through 2021 and early 2022, as inflation soared, they kept the funds rate at zero, which became an increasingly deeply negative real funds rate. That is, they were easing further. And so, all of the dovish Fed members now who are saying, "Oh, you have to watch out for the lags." Why weren't they talking about the lags in 2021 when the real funds rate was becoming -5%, -6%, -7%? I mean, it's amusing if it weren't so serious.
So, Mickey, based on your criticism of the Fed, what needs to change or do differently to avoid where we are now?
So basically, what the Fed needs to do is abide by some simple rules, not mechanically, but be aware of what a Taylor type rule would suggest for where the funds rate should be. Had they followed that general guideline, they wouldn't be in the bind there and now. They would have raised rates earlier. The other thing they need to do is their forecasts, and even the Fed would admit this, were just horribly wrong, and they were based on the Fed's big macro model. How could a macro model that has hundreds of PhD economists working on it completely miss that a $5 trillion increase in deficit spending with the Fed accommodating it and buying half of the new government debt? How could it forecast that inflation wouldn't rise? And so the Fed needs to reassess its model and its forecasting, rely more on anecdotal evidence provided by the 12 Federal Reserve Bank districts. And then it really needs to just assess its overall strategy and put in place, while maintaining discretion of policymakers, put in place some of these rules or guidelines that the Fed actually published in its semi-annual report that it's presenting to the Congress.
Mickey, I just want to put a bit of a pause on the Fed convo because I want to ask you about the housing data that just came out, which showed that we're seeing a big drop in the number of homes for sale, in part because people don't want to sell them and then have to buy something else at quite a high mortgage rate right now. How big of a curb or problem is the housing market for the overall economy right now?
Well, I'm very bullish on the housing market. It's not a problem for the economy, but it's a challenge for the Fed. Meaning, what's interesting here is typically housing activity falls during a recession. Housing has already had its recession and is bouncing back, as you see in existing home starts, new housing starts, existing sales are up. People don't want to sell their existing homes because they have low mortgage rates, so that's reducing the supply of existing homes on the market, and contractors just can't keep up with building. And one of the challenges facing the economy is not weakness in housing, but that when we get out of this soft patch in the economy, we're going to get right back into the supply shortages across the board, not just in existing homes, but in new homes. Now, this is a challenge for the Fed because they know they have to slow aggregate demand in the economy sufficiently to take away some business pricing power to put downward pressure on inflation. So the housing in general is very positive for the economy, and it's a challenge for the Fed on the inflation front.
And I guess a challenge for individuals who are looking to buy houses as well. Mickey, good to see you. Thanks a lot. Mickey Levy is Berenberg Capital Markets Chief Economist for Americas and Asia. Thanks.